As I'm sure you all know, we have a painfully slow market on our hands that could frankly break in the upward or downward direction here. However, on the Thursday session, there was a very nuanced indication in terms of direction. That'll be the focus of today's episode of the Weekly Watchlist because, honestly, other data points remain unchanged on the week. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not done so already. And stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure last week, we're certainly dealing with an indecisive doji. The open and close are relatively unchanged, and there's not a lot of psychology to learn about from the upper and lower wick of the weekly bar, so no edge structurally. If we think about location on the bar-to-bar count, we're dealing with a higher low and an extremely nuanced higher high here, so maybe there's a small bullish edge from that perspective, but the open and close once again remain largely unchanged. So if there's no clear edge, if we're just looking at the scope of 2 weekly bars here, let's expand that scope. Of course, we know that over the past 3 weeks, we've spent the duration of those weeks above the top of the banking crisis candle high, which does strike me as a bullish indication. Continuing to expand scope, we know that we're running into a known area of resistance right here. We've produced essentially a weekly equal high. And if that's the case, the question becomes, if the market pulls back off of this known area of resistance, can we find a weekly higher low? And the answer to that question is yes. If we isolate the weekly to this frame now, we know that we have lows, higher lows, and we're dealing with highs, higher highs, now equal highs. A reasonable higher low pullback will keep us in a weekly uptrend. What else can we glean? Well, of course, it's worth noting that this bullish momentum is starting to slow down. So is it reasonable that the pullback happens this week? Yeah, absolutely. But also, I wouldn't be surprised being in a weekly uptrend if we break resistance in the upward direction. So I think there are some bullish things to glean from this weekly time frame chart, and we'll continue to just reinforce the idea that we are trading above the top of the anchored view app from the all-time high. Strikes me as a bullish data point, and if we come in with our Fibonacci's from the all-time high to the low, we know we're unchanged at the 50% retracement mark from the low up to the most local high in here. We're well above the 38.2. Bull flag consolidation is taking place technically, so I don't really think that the bears have a larger argument other than the fact that, hey, maybe there's a pullback here. Now, I will concede that if this turns into a double top, maybe there's something to be concerned about, but recall that this will not turn into a double top until we actually break down underneath the neckline and produce a set of lower lows. The other way that the weekly trend could reverse back into a downtrend would be with some sort of lower high, and obviously that would require more than 1 week's worth of trade. So I don't really think it's a fair assessment just yet to say that the weekly trend is in jeopardy of changing. So let's take a look at the volume profile. Any changes here? Not really. We're pushing away from the high volume node in the upward direction. We're coming into this next overhead high volume node. Again, is it reasonable that the market pulls back from here? Absolutely. If we catch ourselves for a higher low, good to go. The weekly uptrend that's starting to build out this base in here remains intact. So weekly chart, base in place, relatively unchanged. I think that there's a small bullish edge. As we know, things will become much more meaningful when and if we can get out of this range, hopefully in the upward direction, considering that coming into the top of the range, we have been producing higher lows, and we've been testing resistance in short proximity of time. If we get another higher low and another test in short proximity of time, it's only a matter of time before someone ultimately opens the door as you continue to knock and knock and knock. Let's take a look at the expected move on the daily time frame chart. If you're not familiar with this study, top right hand corner's got you covered with a brief tutorial. Overall, if we are contained by the upper edge of the expected move, the number is 418.45, and that of course would suggest a higher high. If we're contained by the lower edge of the weekly expected move, the number is 406, and that is indicative of equal lows to the original balance area in here. In an overall daily uptrend, right, because we have lows, higher lows, potentially higher lows in here, and along the way highs, higher highs, higher highs, an equal low would not jeopardize the daily trend, right? So as of right now, expected move does strike me as being bullish. Now, we also know that some pretty big tech names will be reporting earnings, and even if earnings are a disaster and we get a 2 sigma move in the downward direction, notice that it still brings us right around the range of that 401 key area of support. That's where ideally a weekly higher low is produced, so keep that in mind. From the trend perspective, as we just pointed out, this could potentially offer a set of higher lows. Not only the Thursday indication, but look at Friday as well. daily hammer candle on the daily time frame chart, obviously, that swept underneath the low of the Thursday session. So as long as bulls open it up above 411.75, I think it's pretty difficult to try to short this market, and it's not going to be easy on the long side. We've seen that back and forth in the previous week's worth of trade. It's just not an obvious short up here at the high. So opening above 411.75, I would lean on bullish outcomes into the coming week, starting to target 416.75, and a move above the top of the weekly expected move takes us to close the gap 420 up to 421.25. Now, key support must be 409 if we're going to try to play this as a daily set of higher lows. Staying above 409 keeps the bulls in control, building a bit of a trend line that looks like this, and we see continuation here. Breaking underneath 409, the expectation should be for a test of the lows at 406, and we'll go on down to the hourly time frame chart now actually to take a look at this. So what was it that I was referring to in the intro about the bullish indication from the Thursday session? That's what it was. It's a bullish indication directionally here from the Thursday session. This, as we know, is representative of liquidation break. So longs with terrible trade locations, specifically from the Tuesday and Wednesday session, get caught on the Thursday session, all close out at once. Very high tempo move that is then almost immediately retraced into the close of the Thursday session. And where do we close above? Right above 411.75. Now, you may call it too close for comfort to say, hey, we have high confidence in that closure above, but look at the Friday session. Again, we undercut the Thursday low. If the sellers were going to have some kind of momentum in here, wouldn't you think that capitalizing on this move here, taking out a day's low, you would at least rotate to the midpoint of the previous range, 409, and then we would start to think of the hourly time frame chart as fantastic. We have a look above and fail. Let's target the bottom at 406. It simply didn't happen. So if we're above 411.75, I think the buyers are maintaining that strength. We've taken out some of the froth of the market in here, the poorly positioned longs. Longs had an opportunity to reposition here on the Friday session, and as long as earnings aren't a disaster, noting everything we've pointed out on the weekly time frame chart, daily time frame chart, primarily there's a small bullish edge opening above 411.75. I think it's reasonable that we look for targets 416.75. It will not be easy trading there based on all of the chop and what we know about the current market conditions, but I don't think it's an obvious short just yet. As we pointed out, something more substantial would be the breakdown of 406, simply noting that this is a very weak level on the chart. It's quite a ways away. It's not instantly in play on the Monday session unless there's some godforsaken news that puts us here, which I'm unaware of at this point in time. So far, so good. Bulls remain in the driver's seat up here, but only by a little bit, only by a little bit. I'm not calling it an easy long trade up here. It's going to be very difficult, but I don't think that this market is an obvious short just yet for all of the indications we just specifically talked about on the Thursday and Friday indications. Market internals are Exhibit A for supporting evidence. If you're not familiar with the screen, top right-hand corner's got you covered with a brief tutorial. First and foremost, let's acknowledge that the bears did have a minor edge here in the internal screen throughout the week, but the focus should be on how bad did things actually get on the Thursday session as that liquidation break was taking place, and is it indicative of new money sellers entering this market, or was it just a little bit of panic? So on the Thursday session, as we're selling off, what do the volume flows do? They're getting close to significant, but they weren't well underneath the negative 300 million mark, and cumulatively on the week, we're certainly not anywhere significant, not even close to negative 500,000. So outflows, not really. If we look at the Thursday session from the advanced decline line perspective, for most of the day, it was trying to trend higher here and specifically into the close as the panic was taking place and we actually took out the morning low. Notice that the advanced decline line actually made a higher low into the close. New money sellers, I think not. If we look at the tick, it was not consistent selling all day. It was really just panic. If we zoom in on this Thursday session, notice that it was just kind of neutral, really wrapped up around the zero line, and only a couple of extreme negative reads into the close. The cumulative build did not really get all that bearish or build consistently throughout the course of the day, which once again is not indicative of new money sellers. So if this is liquidation break and we've already retraced most of that, any short-term sellers who are trying to capitalize on this momentum are technically starting to become underwater. The more time we can spend above Thursday's high, the more meaningful it should become that the market can continue to rotate in the upward direction if this truly was just liquidation break, which the evidence so far would support. Exhibit B is market profile. What can we learn about this? Video tutorial in the top right hand corner if you're not familiar with the terms. Overall, once again, the focus should be on the Thursday session. If new money sellers were entering this market, you would think that as the panic was taking place, sellers were just hammering this thing into the ground. You would think value shifts lower, point of control shifts lower, but on the Thursday session, what we'll notice is that the value area is smack in the midpoint of the profile, as is the point of control. It did not migrate lower with price. We can also say that there was technically a poor low on the Friday session. There's only one tick of excess there, and it was cleaned up on the Friday session, as we know, undercutting the area and then rallying to close back closer towards the opening print and highs of that range. You'll also notice that on the Friday session, instead of value being put down lower in that profile, it's up towards the upper 50%, and the point of control does close right at, very nuanced, but slightly above the Thursday point of control. We have a poor high in play here. So taking out the daily hammer high that we just saw on the SPY chart, getting above the breakdown from the liquidation break, it does sort of support the idea that new money sellers are not entering this market. Short-term shorts with terrible location looking to capitalize on that momentum down here towards the lows should start to get out of this market, aka add buying pressure over Friday's high, over Thursday's high. That, of course, keeps the bullish rotation alive and doesn't really support the idea that this market is ready to go to hell in a handbasket. Jumping back on over to Thinkorswim to evaluate the weekly performance of our sectors reveals that we were led by staples this past week, up 1.65%, followed by real estate and financials. At the bottom of the barrel, we see energy down 2.25%, followed by communications and the tech sector. So posture here is not really looking all that great from a risk-on perspective, but one note about posture is that it becomes much more meaningful when and if we're looking for a break of a balance range, right? Let's just say that we break out here. The question becomes, is the heaviest weight risk-on sector, the tech sector, leading the rally, or is it a flimsy rally being led by utilities and consumer staples? That would obviously be a red flag. So watch for the posture to become much more important when we get a definitive break of balance. Let's for now just check in on the structural charts. What's going on here? Certainly in the XLP, large shooting star on the Friday session with a big gap up there. Even if this pulls back, there's a strong likelihood of a higher low above the top of the balance range in here, which is kind of unfortunate considering the tale of two balances that we discussed with the XLK. We'll get to that chart in just a moment. Unfortunately, if we do find a higher low here, and this is what leads the market rally, again, it's kind of a red flag. So not really enjoying what we're seeing out of the XLP. XLRE for real estate, although it's towards the top of the list over here, it's really doing nothing in this box. It's a lightweight sector. It's helpful if it breaks out over 37.45, but much more to do with the wealth effect, of course. Let's take a look at financials. This definitely is a little bit more meaningful. Notice on the Friday session, the hammer candle low undercuts Thursday, Wednesday, Tuesday's lows, and then closes back in the Thursday session. To me, this is a strong opportunity for a daily higher low, continuing the break of this balance range in the upward direction and retracement through the thin structure from the banking crisis breakdown. So this does strike me as a bullish data point for our markets. Next up is utilities, playing nicely in the sideways box. This is ideally what the consumer staple sector would have done. Obviously, it's not the case. So as long as utilities remain under 70, that is helpful from a posturing perspective when and if the market sees a break in the upward direction. If the market sees a big breakdown, you want the breakdown to be led by some mild like chop in utilities. You want the utility sector to hold up, you want XLP to hold up, and really a large breakdown to also be led by the XLK, for example. We'll get to that chart in just a moment, but so far a neutral data point. XLI for industrials. Overall, here's the balance range. Here's a multi-day balance forming. Does strike me as a slightly more bullish than bearish data point considering we have higher lows that have continued to build out, highs, higher highs, looking to see if we can get back to the top of the range. Bullish data point. If we do start to just noodle around in here, it's exactly that, just neutral. Next up, XLY. This is where work must be done. Okay, so this is one to focus on. We sort of breezed through some of the other ones. XLF looks bullish. XLY, it's gotta show and prove. How many weeks have we been talking about this? Over 148 will be supremely helpful for the market itself if we're trying to break this balance area in the upward direction. I'm a little bit optimistic of this outcome, simply noting the fact that along the way, the buyers have continued to step up and produce higher lows. We had an inverted hammer from the Thursday session closing weak on the lows at the 50 SMA, potentially threatening a move all the way for the equal low. Obviously, Friday reversed that. So again, I'm a little optimistic here that we can see a break of 148 that would certainly help the bull case in the SPY itself. So 148 still a primary watch out of the XLY. If it just starts chopping around in here, I think it's really difficult for the market to gain traction. Energy, speeding up through the lightweight sectors. Not much to talk about here. Balance is performing nicely. A breakdown through the bottom end of the range is not the end of the world. This is D for defensive. It is a risk-off sector. Not going to matter too much if the market's trying to move higher and energy's closing that gap. XLC, communications, it's done the work. It's already broken out. Compare that to the really neutral look of the XLY. Mild pullback, and might I add, on every single gap down, we've mostly closed the gap or had a green day. Every single one of those bars is green. So buyers are not just like throwing their hands up in the air and surrendering the XLC. There's clearly a strong opportunity for a daily higher low to be produced anywhere above the top of the breakout point here at 56.75. That would also be a reasonable watch, higher low out of the XLC. XLK, where we start to see some concerns, right? XLP, XLK, that was the tale of two ranges. The XLP broke out, the XLK did not. But one thing to note here is that we did produce technically a hammer on Friday. If we can take out Friday's high, rotate to the top of the range, and attempt a breakout, that would be helpful paired with the XLY, wherever you are in this lineup. XLY breaking out over 148. So watching the XLK, can we get back above 149.15? Hammer candle leads me to believe that the sellers aren't really all that strong just yet. Still optimistic until we get a daily bar close underneath 147.25. That would be the flip of roles, right? That would be the role reversal. We'll definitely change our tone if that happens, but so far, so good out of the XLK. Next up, we've got the XLB lightweight sector materials here, balancing. Same idea with the lower wick from Friday. Does strike me as optimistic for a higher low being produced. Lightweight sector, it's helpful if it breaks out, but not the end of the world if it doesn't. XLV, second heaviest weighted sector by market cap, certainly, helpful for keeping the markets hanging in there sideways. This is D for defensive in terms of posture. It's the second heaviest weighted sector though, so we can't afford for it to break down and retrace through this thin structure that probably results in a breakdown out of the SPY. So what's the key watch? It's really Thursday's low, right around in here at 132.75. Anything that's consolidation up here is clearly just a bull flag and looking for continuation. That is helpful actually, even though it's D for defensive and posture, it's helpful for continuation out of the SPY. Here's the sector ratio grid. If you're not familiar with how to set this one up, top right-hand corner's got you covered with a brief tutorial. Overall, the top four are the heavyweight sectors for the market and relatively unchanged from the last check-in we did on Wednesday. Tech strength continues to fade, a little bit of perking up in the financial sector, continued just slow grind lower out of discretionary as XLY stays underneath 148. A little bit of perk higher into the close of week in the XLV. So that's something to keep an eye on, remembering that although it's the second heaviest weighted sector in the S&P, it is a bit more D for defensive in terms of posture. Speaking of posture and risk off, bottom four are the risk off sectors. Notice the uptick into the end of the week, the uptick into the end of the week. They're not a concern yet. They're not in blatant uptrends like what we have in here, but certainly threatening more of a risk off look. If we see a break out of the S&P and these things start to outperform with the continued deterioration here, and here under a 50 SMA perhaps, that would be a red flag. We don't have it yet, but it's something to keep an eye on. Next up, we've got the XLY over the XLP. What's going on with growth versus value? Almost identical to just the XLY ratio itself, with still some opportunity for a higher low being produced here to here at our gray bar. So not a threat yet, but just continuing to be a neutral data point. Checking in on the good old dollar, notice that the data still looks funky, but we are unchanged on the week, still spending time underneath this balance area in here, which in theory would mean that, yes, there's a slight bullish case to be made for equities, especially when we compare this with the hold in gold at the retest level of 2,000. Now, we did close underneath as of Friday's end of the session, so keep an eye. If the gold contract starts to break down here and the dollar starts to rally higher, in theory, maybe things deteriorate in the equities market, but so far, remember that the first test is the best test. That's really where you want to go for the retest trade. If this just continues to chop around without significantly making a solid momentum push away, it's not a concern yet. It's still trying to resolve the second test of 2,000. Unfortunately, this hammer candle did not result in a move back up to the equal highs. So a little bit of weakness out of gold could be concerning for the dollar and thus equities, but the relationship has not completely deteriorated just yet. Let's take a look at the TNX, which is starting to become a little bit of a concern, especially if we're looking for some sort of uptick out of the tech sector specifically, and even discretionary is widely impacted by rates here. Notice that we have a move back into this balance area after the breakdown of this big shelf of support on like a weekly time frame chart, and now we're producing a higher low in this box right here. The concern would be higher highs out of rates. The TNX over 36.4, it's 3.64 in the 10-year rate itself. Keep an eye on that. Looking left, left, thin structure, a rotation all the way to 4.0, that would be really, really harsh for this market. Remember that interest rate volatility in this segment of the chart really caused the very difficult conditions that we're dealing with at this point in time. It would be less than ideal to see a breakout in the TNX. The Fed tracker tool continues to show us higher odds of a 25 basis point rate hike in the May meeting here, and the higher for longer narrative remains unchanged as well, noting that the first cut is really being priced in the month of November. So that's fine and dandy, no changes there. The big deal, of course, remains earnings. Like, what do we have going forward? It's a jam-packed week. Almost everything on this list in front of you will be market moving, but obviously some honorable mentions: Microsoft and Google, Boeing and Meta here, as well as Amazon. So pause, screenshot, whatever. Very busy week. Now, how did last week go? Well, what we'll notice is that 18% of S&P companies have actually reported, and 76% of the 18% have reported positive EPS surprises, and 63% of S&P companies have reported positive revenue surprises. And although an earnings decline was sort of priced in, the response to these surprises, although it's right in line with the average, let's go ahead and take a look at page 6 over here. So percentage of companies beating EPS, right, 76%, is below the 5-year average. However, compare that with the reward that companies are getting, right? On average, typically there's a 1% increase when a company produces a positive surprise. Right now, it's a 2.2% surprise, like move in the upward direction when a surprise is produced. So you've got to scratch your head and think to yourself, okay, what does that mean? Well, if we were pricing in really abysmal outcomes and now all of a sudden things are not nearly as bad as they potentially looked, are we closer to, when the Fed ends their rate hiking campaign, are we closer to returning to higher profit margins, better spending out of consumers, and will these numbers bounce back? And ultimately, that is why I believe companies are being rewarded, the stock price is being rewarded when we see a big beat out of the EPS numbers. Let's take a look at growth for the next quarter. If we go on down to page 23, where is 23? There it is. What you'll notice is, XLY. That seems to me, if I remember, to be a risk-on sector and threatening, or needing rather, I should say, a break of 148 on the structural chart. The forecast for Q2 tell us that it should be at the top of the list. And again, the idea is not to go out there and look for companies who are going to beat on earnings. The idea is not to say that the XLY must perform 26% better in terms of growth here. The idea is, what is in the mind of the market right now? The market is forecasting some growth out of the XLY, and as we know from a posturing perspective, that would be helpful if the market is going to continue in the upward direction. The absolute number is not so important, it's the general direction. Notice we're also looking at communications and financials outperforming. At the bottom of the barrel, it's the energy sector, risk off, materials, lightweight and also inflationary, and healthcare, more indicative of a recession, contracting in terms of earnings growth. We could say the same thing if we look at the earnings not the earnings calendar, but the forecast for the full calendar year rather of 2023. Discretionary, communications, industrials, financials, all more indicative of a healthy economy, more of a risk-on type look. At the bottom of the barrel, it's the risk-off sectors, it's the inflationary sectors, energy, materials, healthcare. I will completely concede that infotech is flat to slightly negative here. It's not the best look, but if we can, make up for that slack, if we can pick up the slack in the discretionary sector and the communications sector, certainly seems risk-on enough that the market can find a footing in the upward direction. And when the rebound of tech comes, you've got to scratch your head and think, okay, if this comes later, after this, it continues to propel the market higher perhaps, right? So the forecasts are looking pretty good. And again, the idea is not that these numbers are absolutely correct. The idea is that we're looking at what the expectations for the market ultimately are. If we take a look at page 31, here's the forward 12-month PE sitting right around our average rates. The 5-year average is the green dashed line. I will concede that, yeah, it's probably higher than it should be based on what took place from the sickness. But hey, we're dealing with reality. That's the average. We're right around the average. Stocks were cheap at the major drawdown of the overall move, and we've already recovered just a little bit. Even if you take a look at the trailing and the actual 12-month PE, right? Are stocks cheap or are they expensive? Well, as of right now, we're kind of coming off of these lows into the territory where, again, this probably dragged the 5-year average a little bit higher than it should be. But even if you draw in a box that looks something like this, are we trading in the normal range or extremely expensive range of PE ratios for stocks? And when I look at this, I think to myself, like, again, could a bottom be in? Could a bottom be in? Not definitively, it doesn't have to be the bottom, but could the bottom be in? Is it worth at least entertaining the idea that fundamentally things are okay, they're not continuing to deteriorate? Is it possible that a bottom could be in play? And I have to answer that with Yes, based on the data in front of us. Again, this has nothing to do with how we should act on the Monday morning session as a day trader. But overall, the narrative that this market needs to go to hell in a handbasket is not being supported thus far by earnings. Could that change with Microsoft? Could that change with Google? Perhaps, but we don't have that data yet. Risk appetite charts remain unchanged, continuing to see the fade out of the relative strength line in the TLT towards the SPY, so no flight to safety trade taking place over here. Looking at the HYG, it's still telling us to be cautious about the rally in the equities market, noting that this is the equivalent balance range. We're still technically above, but remember the equal highs versus the higher highs being produced in here. It's not favorable for continuation under these circumstances unless the HYG breaks out, so keeping an eye on that. And of course, looking at the digital gold, it's worth noting that we did see a breakdown of the top in here. So if this continues to move lower, it's definitely more of a risk off signal, but again, not one-to-one. Breadth indications are also unchanged. Notice new highs versus lows still hovering around the zero line. Let's take a look at the SPX A200R. This is a weekly time frame chart, unchanged week over week here, but still above the 50% mark. And SPX A50R daily time frame chart. Now stocks trading above their 50 SMA. As we've just grinded higher, we have recaptured the 50% mark, but for the most part, just going sideways here, not a substantial push like what we had in this segment of the chart right here. Let's take a look at the RSP equal weight S&P 500. The concern continues to be that we're so far removed from this local high, whereas in the SPY, we're attempting to get a break of that weekly equal high as we speak. So this is still a red flag, no changes there. And if we look at the DJI Dow Transports theory, this is also building as a small red flag. So this actually is, we can learn something specifically about the Thursday session, right? As we attempt to break this ascending triangle on the Thursday session, the fact that we did not get follow through would start to be a red flag. Now, I have to also say that yes, there's a bit of an indecisive doji / hammer-esque type doji on the Friday session. We're not completely removed from the breakout point in here, but on Thursday specifically, it was a failed break. That is a red flag if we are looking for continuation out of the industrials, which of course is more loosely tied to the broad market performance as a whole. Red flag. Okay, so not everything's terrible. Most things are unchanged, but this for sure is a little bit cautious. Not great. VIX volatility unchanged and suppressed. VVIX volatility is jumping through the sky here, in my estimation, really due to earnings, but definitely a red flag. Keep an eye on that. Would speak to the expected move being breached either direction, up or down. VVIX is a red flag. Let's take a look at the volatility futures, and to round it out, unchanged here as well. For the most part, deeper contango, well underneath the zero line, staying underneath the zero line in 9 versus 30-day VIX. So short-dated options, long-dated options, so far pricing in more risk in the unknown future versus the present-day. Money managers certainly like that to allocate capital. QQQ weekly time frame chart. I know the structure is looking quite small right now, but for the most part, it is an indecisive doji, a little bit more of a red body on this bar. But as we know, we are dealing with a stronger weekly uptrend on the QQQ's clear higher low, clear bull flag consolidation taking place right here. We've got multiple inside bars, so we'll learn something when and if we break the top or bottom of this range here. You can clearly see the all-time high anchored VWAP. We're spending some time above it, sort of muddled around in this area, but for the most part, the most noteworthy portion of structure is spending this consolidation above the previous pivot top in this area right here. Let's take a look at the volume profile on the QQQ, and as we know, we're running into significant resistance at this shelf here, but when and if it breaks in the upward direction, there's quite a ways to run. This, of course, is the next major target, closer to 340, and then after that, things really open up 365 potentially. Again, not calling for it in the coming weeks worth of trade, but certainly starting to think about this as a constructive bottom out of the QQQ. You could call this a simple double bottom. You could call it a head and shoulders double bottom, right? Something that does this. A break of the neckline, certainly constructive in the upward direction for our weekly QQQ. Let's go ahead and take a look at our daily time frame chart now for our QQQ and throw the levels back on, see what's going on from an expected move perspective. Certainly dealing with a higher high potentially or a lower low. So that's a difference between the Qs and the SPY. It's really been stuck in a balance much more so than the SPY, which is trying to grind in the upward direction. Clearly, we're just sideways here. Just like the XLK hammer candle on the Thursday session, closing back inside of the Friday range after breaking the low, testing the bottom end of the channel as support. To me, it's constructive over 318, higher lows, something like this. Break of 320 is really what the patient bulls are waiting for. Up and out of the balance range. Bears, of course, down and out underneath 314 with the support from the Friday session and what we've seen so far based on the intraday dynamic of the liquidation break. Again, you can see that happening here. And then the retracement, again, failure, failure, failure intraday on the QQQ. Hourly time frame chart shows us an afternoon pullback, then holds 316.25, the previous lows and flush point from in here, holds it as support and closes above. Again, not out of the woods, but some small bullish edge directionally, looking for an open here and then constructive higher lows over 318, test 320 top of the range. Again, patient bulls want the break of 320.50 in the first place over the top. Patient bears, again, just wait. 314 on the downside. Nothing about this chart yet is telling us stronger sellers are getting involved. QQQ internals, again, just noting the lack of strength from the sellers on the Thursday session, just like the S&P net on the week, not really substantial outflows. Yes, we were negative on the advanced decline line, but again, illustrating that we did not make a lower low in the AD into the close there. Ticks were definitely more intense in the downward direction on the Thursday on the NASDAQ side of the exchange itself, but how did we ultimately follow it up with price? Again, we're just stuck more firmly in the range. It shouldn't really be a surprise there. I will concede that intraday, there's definitely been some more bearish things going on in the tech sector specifically. With earnings coming out, I'm not sure I would be overly reliant on these signals until things like Microsoft, Google, Meta are out, Amazon as well, of course, fitting into the XLY a little bit more appropriately. Let's take a look at the market profile for the NQ as well. So NASDAQ futures here, there's your Thursday breakdown. Where's the point of control? It's still high in the range. It did not migrate lower with price. What happens on Friday, just like the S&P, repair the poor low from here, put in decent excess, close the point of control and value area overall higher in the profile. I'm just not convinced we have new money sellers. The Russell is so unchanged that we don't even need to reference a weekly time frame chart. We're underneath the anchored VWAP bands. We know that there's relative weakness here. So nothing important happens in the Russell until we take out the top end of this balance range here. Over 180.25 would be the ideal break, specifically noting that if we take out the anchored VWAPs from the October low, anchored to all the key pivots after the October low, this is strong confluence of resistance right around this area. Also represents the beginnings of an overhead gap close, very small gap close, but up to that prior breakdown bar low. Of course, when and if we can get out of the balance range, this one in here, looking left, there is thin structure to retrace through, so the target would be quite considerable in the upward direction towards 186.75. With the Friday hammer undercutting the Thursday low, closing back high in the Thursday range, I would say that, again, there might be some sort of bullish edge, especially noting that we have lows, higher lows building out. If there's an attempt, I would not necessarily try to fade that attempt, noting that the buyers have been making incremental progress in the upward direction. Referencing something like our market profile, here is the Friday session specifically. Once again, where's the point of control? Higher in the range. Where's the value area? Higher in the range. What did we do? We repaired these poor lows, poor low, and not poor, but it really didn't have meaningful excess, we can say. This put in good excess at the lows and once again closed back inside of the 2-bar range, closed back inside of the Thursday range, and for all intents and purposes, with these higher lows happening here, here, and here, I would sort of look to go with an attempt to break out of this balance range. The key will be if we fail back into the range, okay, massive red flag for the market. But if we can catch ourselves for a higher low, we know that the IWM and Russell acts as a leading indicator, more of a risk-on indication for our markets if this were to take place. So watching closely, the key pivot 180.25. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that, we'll jump right into Apple. What's going on here? Certainly a rejection of the 3-day balance range on the Friday session. If we look at the hourly time frame chart, I specifically want to show you that it's only in the first hourly upper wick that we even attempt to spend time in the 3-day balance range here. All of the value subsequently on that session was underneath 165.50. So staying underneath 165.50, you can imagine that there's a flush point underneath Friday's lows to start to target 162.25. If this is going to turn into a look below and fail, it needs to be a higher low back above 165.50, and early in the week, we can look back for the rotation up towards 168. Earnings are not as much of a consideration this week. They will be next week for Apple, but so far based on this structure, favoring a break of Friday's low, rotate here. If it wants to give us the look below and fail, that's fine, but it needs the proof first with the higher low back above. Next up, let's take a look at Netflix. What's going on over here after earnings, offering some pretty mixed signals. Hammer candle, upper wick, inverted hammer candle, closing right kind of in the midpoint of this nasty little chop range. I would say that the primary focus should be to find lower highs underneath 332.50 to continue to trade this in the downward direction, noting that this overhead supply is weighing on us in the downward direction. If we do get a break of the level, just like Apple, but on a higher time frame, obviously, we need a higher low back above that level if we're confident in longs to rotate back up towards these highs at 348.50. Next up, what's going on with Tesla? Earnings as well, sort of destroying this, giving us a little range to look at. but not really offering much in terms of indications here. It was a complete inside bar on Friday. Over 167.20 closes the gap overhead. Under 161 interacts with this previous gap over here. Under 154.80 closes to 146.50. It's just a pure patience play in Tesla. Look at the hourly. I mean, nothing really substantial taking place here. I suppose strong support Friday in the morning, but even that, I wouldn't really go just based on that. It would need to be the crack here into those gap levels overhead. Next up is Google. What's going on? Again, sort of not a patience play. I do think that this could be in play early on in the week, but it's got to be a break of 106.50, targets what was acting as a double top area at 108.75. You could trade intraday higher lows off of that level. Breaks of this level on the daily time frame chart, just chopping around in here is exactly that. It's choppy. We don't have a lot of directional indications there. Obviously, a breakdown is under 103.75. Next up is Zuckerberg's Fantasyland. And keep in mind, some of these companies are reporting earnings, specifically Google, Meta, Microsoft, Amazon this week, right? So what's going on here? Continuing to look for downside outcomes. Again, I would not trade this around earnings specifically. Maybe Monday we can trade it before IV goes off the wall, but for the most part, breaking down from overhead supply, rejecting it again on the Thursday session. Gap close on Friday. Lower highs are just ideally underneath 213.50. Rotation is to 207. Here's the hourly, clear as day, right? So there's a balance range. Rally to close the gap, looking for a lower high underneath, keeps this kind of intact here. And then again, probably not touching it as we get closer to earnings. Next up is NVIDIA. I guess we can stay on the hourly time frame chart for now. You can see that this double top is in play. There's your neckline flush, and we're underneath that. So what's the idea? Obviously, you want the neckline to remain intact. Lower highs for bears are underneath 274.25. Target the bottom of the range at 262. Daily time frame chart for the folks who really want the big breakdown in NVIDIA. That's a day trade that we just outlined on the hourly chart, right? If you want the big swing trade short, the big follow through move, even as a day trade short, it's the flush underneath 262. Once that happens, we have thin structure off to the left. Is it overextended? Possibly, yada, yada, yada. It's been the stock that's unshortable. So don't feel like you have to be the first one in the door. We've talked about this time and time again. Wait for a lower high underneath. You don't need to be the first one here, right? You could wait for the equal low break. Don't be the sucker who gets fooled out of the short thinking that you're going to get this huge payday. Respect NVIDIA. Respect the levels that are going on currently. Daily time frame chart, it's just in the midpoint of a range. Day traders have that hourly setup we just walked through, but other than that, not much going on there. Let's take a look at Microsoft. Same idea. Where are we? We've got a daily range, and we're in the midpoint. Swing traders, nothing going on here. It's over 289.25, under 281.50 closes the gap. Earnings are a contender on this one. Hourly time frame chart for the day traders. Again, nothing even clear here. I suppose you're looking for a lower high just trade the channel. It's as simple as that one in Microsoft. It's not going to be easy, but the levels are at least easy to identify. Next up is Amazon. This is actually where there is an opportunity. Unfortunately, again, earnings. Hopefully it doesn't destroy the IV on the chain too much, but for the most part, Amazon had a solid break into the close of the week, whereas everything else was balancing. So if Amazon can catch itself and remain over 103.90 on any pullbacks, on anything off of this 108 resistance here, looking for higher lows to be constructive in the upward direction, or just straight up continuation. If it is straight up continuation, here's the hourly time frame chart. You can clearly see we need a break of Friday's high and then a higher low above to confirm we're turning what was once resistance into newfound support. 108 would be the pivot. It might be a little bit shy of that, 107.85, give or take. All right. So that is the core list. It's your final chance. Bell button, subscribe button, thumbs up button, all that good stuff YouTube tells us to tell you about. And let's dive right into these ideas. ABT, Abbott Laboratories, is up first. And our good friend Al Brooks would annotate this setup right here with a very simple parentheses, lowercase I, you got it. It's a double inside bar. If we take out the top of this pattern at 112.32, we're looking for a rotation into the double top from back here at 115. It's also going to be a break of this general shelf of resistance from in the past. So that's a long-sided trade in Abbott. We've also got a gap and go from earnings, power earnings gap up at our backs. And also, let's just go, all the way with it. An inverted head and shoulders is also resolving in the upward direction. So that's Abbott on the long side of the market. Next up is a longer time frame pattern to just pay attention to. This is DoorDash, of course. Shout out to all the Dashers in the comment section, but we've got a little bit of a symmetrical triangle going on. It's running out of room, but if we get a bit more nuanced, if you want to day trade this, I'm not sure how the options chain is, but it did strike me that this bullish engulfer that tested under Thursday's low, the story is always the same, found support, closed above Thursday's Thursday's high, maybe, again, we also get a double top target here, 65 roughly on Dash, if we can get continuation out of this in the upward direction. But really, it boils back down to the longer time frame pattern just to keep an eye on. Last but not least is ORCL, Oracle, not the Oracle of Omaha, but the Oracle of Tech, perhaps, obviously. And we're dealing with a strong move in the upward direction, reasonable higher low pullback, another push. What does it do? This is the key here. It produces a higher high. So once again, is it reasonable that we can pull back and afford a higher low in the overall trend sequence? The answer is yes. On Friday's session, the story is always the same. We undercut the Thursday low, close back in the Thursday range. If we take out Friday's high, look for the equal high to be produced over 95.30, targets 96.50. I wouldn't overstay your welcome, especially as the market's trying to form, an indecisive balance in the SPY and the Qs. We're not looking for a moonshot here out of Oracle, but just an equal high potentially as a day trade. The options chain here is far superior to that of Dash in my estimation. So that's what I've got for you in today's episode of the Weekly Watchlist. Just to sum it up for all of you who made it to the very end, let's not forget the main point of today's video is to point out that based on the price action here, liquidation break, and then the hold back above on the Friday close, supported by not new money selling in the market internals for the NYSE specifically, does not have me feeling convinced that this market is going to break down and go to hell in a handbasket. Unless we get some major surprises out of earnings, I think that the status quo should be to be cautious about upside outcomes, but to not be overly aggressive on the short side here. That's all I've got. Hopefully you enjoyed it. If you did, let me know in the comment section or by giving the video a simple thumbs up. And I hope to see you all on the pre-market prep tomorrow morning live at 8:30. I wish you all a green trading week.